$20 a day. That's an Uber Eats order, a couple of coffees. The amount most people spend without even thinking about it, and they forget about it by Tuesday. But I ran the numbers on what happened if you'd invested that exact amount, $20 every single day starting January 2022, into 5 different assets. Same money, same discipline, same 6.5 years. And one of them turned $47,000 into $700,000. One of them lost you half your money. And the strategy that most people on finance YouTube would have told you to follow, the safe, sensible, diversified option, came in kind of last. Except for the losing bet, at least among the winning choices, right? And by a margin that should genuinely change how you think about where you put your next dollar. The uncomfortable truth is buried in these numbers, and nobody really wants to say it out loud. Look, you've been told your whole life that investing is for people with money, that you need a big pile of money to get in. You need to time the market perfectly. Well, the people getting rich in stocks and crypto, maybe some of them started with capital that you don't have. Maybe they got lucky. But that's a story that's keeping you poor. Not because it's malicious, but because it feels true when you're looking at your bank account on a Thursday wondering where the month went. Where's all your money? $20 a day doesn't really feel like investing. It feels like what's left over after everything else. The amount that you'd spend on just something stupid without even noticing it. The number that seems too small to matter. So it's important because what I'm about to show you is what happens when that little amount, the one that feels too small to matter, compounds over 6.5 years across 5 different assets. The results are probably going to make you angry that you didn't start investing earlier, that you didn't be more consistent with your investing, that you're not more consistent with taxing yourself and putting money into the market. But here's the number that genuinely should stop you when I ran these numbers, because one of these assets didn't just outperform the others, it outperformed them by a wide margin, a margin so extreme that it breaks every assumption about what a retail investor with no special access, no insider knowledge, and no timing skill can actually achieve in the market. And it's not Bitcoin. Whoops. Here's what it is. So, $47,760 is from January 1st up until today. You'd invested $20 every day. Same start date, same discipline. Here's where each one of these assets sits today. So let's start off with the boring option, the NASDAQ 100, the QQQ. Now this is the recommendation that every sensible financial advisor would give you. It's diversified, it's got low fees, exposure to the best companies in the world. Well, your result, $76,000 to $82,000. A solid 60 to 70% return on your money over 6.5 years. Annualized at around 15%. That is nothing to be embarrassed about. That's great, man. Good money. Bitcoin. Let's talk about Bitcoin. Through the 2020 pandemic lows under $10,000, through the 2022 crypto winter, through every headline that said Bitcoin was done and dead and over and never coming back, the result is that today you'd have about $185,000 to $210,000. 3 to 4 times your money. 4 times what the QQQ delivered. Not bad. Same daily amount, same discipline, dramatically different outcome because you were buying large quantities of cheap Bitcoin in 2020 and 2021 before the institutions arrived and ETFs came and all the other kind of stuff. Now, keeping with the crypto theme, top 5 crypto baskets. We're going to buy equal weights, $4 a day of Bitcoin, Ethereum, BNB, Solana, and XRP, equally weighted. The diversified crypto approach gave you a result of about $240,000 to $275,000, slightly better than pure Bitcoin, carried by Solana bought under $3 and BNB bought at $13 in early 2020. Even with Solana's huge 2022 drawdown and everything else, the DCA through the bottom and the subsequent recovery produced returns that beat pure Bitcoin on a blended basis. Now we're in a bear market, so those have bled more versus Bitcoin. Next bull cycle, I'd assume that they're going to have even bigger results. PayPal, this is next. This is the cautionary tale which you need to hear before I give you the next investment, because buying just one stock works amazing if you get the right one. The tricky part's picking it. See, PayPal is a company that looked like the future of digital payments back in 2020. But the result, if you would put that $47,000 in, you'd have about $24,000 to $28,000 right now. You lost half your money. That's significant because when you DCA a structurally declining business, you don't average down into recovery, you average down into permanent impairment. Dollar cost averaging is only as good as the asset that you're buying, which let's talk about one of those. The big daddy, Nvidia. You would have got $650,000 to $720,000 on the $47,760 you invested. 14 to 15 times your money back. The single stock that buying $20 of every day turned into life-changing wealth because you're accumulating massive share counts back in 2020 and 2021 and through the 2022 crash before the AI supercycle sent a parabolic from 2023 onward. It's an outlier. Could run the same numbers as SanDisk or Micron and get probably similar results. And if today's numbers just convinced you to start, by the way, guess what? You need a platform that makes the daily purchase automatic, reliable, and actually trustworthy with your money over the long haul. That's why I want to tell you about the Kraken exchange. It's not just a crypto exchange anymore. And it's actually an exchange that I've been using since 2019 with no problems. They've been over a decade in the market. They're regulated, they're audited, they're available in all the major jurisdictions like the USA, the UK. And it's got the kind of institutional grade security that matters when you're building a position over years, not just over weeks. Because the whole point of the dollar cost averaging thing is that you never stop, that you be consistent. And you need an exchange that's still there for you in year 6, the same way it was there for you in year 1. Otherwise, the DCA process doesn't work. On Kraken, you can buy Bitcoin. You can buy any of the popular crypto coins, and now you can buy stocks. They get all your favorite stocks there as well, all in one place. Set up automatic recurring purchases. They got the deep liquidity, zero drama. Again, the strategy only works if you never stop buying, so you need a good place to do that. That place is Kraken. Kraken makes sure that you never have to miss a day and that you have no reason to stop. Sign up using the link down below now and get started. Okay, so look, the PayPal number is the most important one on this list because nobody wants to talk about it. Dollar cost averaging is not a magic strategy. It's a discipline. And discipline applied to the wrong asset produces disciplined losses. Buying a broken business every day for 6 years doesn't fix the business. It just means that you owned more of something that was declining the entire time. The lesson isn't DCA works. The lesson is dollar cost average into quality assets works. The strategy and the asset selection are two separate decisions. Most people get the strategy right, but the asset selection wrong. I've seen this so many times in crypto where people keep buying these layer ones and shit that just are destined for the dustbins of history, doubling down and losing bets. Nvidia illustrates the other side to an extreme. Nobody in January 2020 knew Nvidia would become the infrastructure layer for the AI revolution. You didn't need to know. You just needed to recognize a dominant semiconductor company with an expanding addressable market and buy it every day regardless of what the news said. The compounding did the rest. The NASDAQ number, about $80,000. That is not bad. We cannot dismiss that as being a bad investment. But it's a reminder that broad diversification protects you from catastrophic loss. It also limits your exposure to catastrophic gains. Now, the NASDAQ owns Nvidia, but it also owns hundreds of other companies that dilute the Nvidia effect. When you owned Nvidia directly, you owned all of it. Now, here's the portfolio that makes sense if you're starting this today. Because past returns, of course, tell you what was possible, not what's coming. But we can extrapolate average returns for the assets. And for the average investor coming in, you probably don't want to do 100% Bitcoin. I've got a very large percentage of my portfolio in Bitcoin, but let's just say, you're a more conservative investor. You still want to have good returns though. 75% NASDAQ, 25% Bitcoin, $20 a day split between them. The historical blended compound annual growth rate of this combination from 2020 to 2026 was approximately 21 to 23% annualized. The NASDAQ contributed 14 to 16% compounding. Bitcoin contributed a volatile but powerful 40 to 45% annualized return from a low base. The reason not to go all BTC, and this is, I'm a BTC guy, don't get me wrong, but it's the sanity. This is an asset that will test you like no other, and a lot of people are not ready for that. The NASDAQ softens that out though while maintaining solid growth of the BTC as a very core piece of the puzzle. If you start today with whatever you've accumulated already, let's say it's $100,000 based on the past 6 years, and you extrapolate that out for the next 6 years, and you keep putting $20 a day in for another 6 years, the projected outcome of that blended historical return is around $430,000 to $475,000 from just $20 a day, from money that most people spend on nothing. Now, the critical caveat that nobody wants to say, the math only works if you don't sell during the crashes. The 75-25 portfolio will see Bitcoin drop 70%. We'll see the NASDAQ drop 30, 40%. Both at the same time, probably. When the next real bear market comes, these are both going to get smashed. The people who hit $430,000, or might even be more, maybe get $1 million, Bitcoin outperforms, right? These are going to be people who just didn't check their portfolio in March 2020 and other crashes. They just kept the automatic purchasing running. The strategy is simple. The execution is where everybody fails. $20 a day to Nvidia turned into $700,000. $20 a day into PayPal, you lost half your money. $20,000 a day into Bitcoin and the NASDAQ, you made very nice returns. Same amount, same discipline. The difference is where you put your money. Most people are going to read that and start trying to find the next Nvidia. It could work out very well for you, but it's kind of the wrong lesson. The right lesson is that boring automatic daily investments into assets that you actually understand and that you actually believe in, compounded over years without interruption, produces outcomes that feel impossible until you see the math. The people who got rich on this list, they didn't time anything. They just didn't stop. $20 today, same tomorrow. Don't touch it when it crashes, and you will retire rich. That's the entire strategy. And it works.